Hello and welcome back to another Camtasia video lecture. We're still dealing with chapter 3, and chapter 3 is still pertains to job costing, but this time we're looking at how costs flow through the job costing system. So up to this point, we looked at journal entries, right? We said let's use the T accounts because T accounts are sexy, right? And they're easy to use. Um, and it gives us a nice visual representation of really how the costs flow through the accounting system. Now in this video, I want to look at two schedules. I want to look at the cost of goods manufactured as well as the cost of goods sold. We're going to see in this video how to prepare both of those schedules. Okay. Now, the good news is we've kind of already built the base as far as our knowledge goes on how to prepare this schedule of cost of goods sold. This schedule, or I'm sorry, cost of goods manufactured. This schedule of cost of goods manufactured is more uh, it takes those how costs flow, and it puts it into a statement. Okay, so as long as we understand how those costs flow, which we'll hit that again in this video, we'll see how to prepare this cost of goods manufactured statement. So the first thing we need to really recognize is that when we're preparing this schedule of cost of goods manufactured, as well as cost of goods sold, right? There's three main costs, right? Direct material, direct labor, manufacturing overhead. We know that those are our manufacturing costs, and we also know that for financial statement purposes, we call those product costs. Okay, so we're still working with the same material, right? We're still looking at the three major costs, or manufacturing costs, really. Okay, and what we're doing is we're going to make schedules. Okay, and these schedules are going to allow us to calculate two very important things. First and foremost, it's going to allow us to calculate the schedules for our cost of raw materials and direct labor that we actually use in production. And it also allows us to determine or schedule the amount of manufacturing overhead that we apply. Okay, once we are able to schedule and or let me phrase that, once we use these schedules to calculate those costs, we can then use this cost of goods manufactured, cost of goods sold schedule to calculate the manufacturing costs that we're going to associate with the finished goods, right? And again, when we say finished goods, we're talking about the goods that were finished during the period. What did we put into our finished goods inventory account? Okay, so these next three slides really walk us through how to put together this cost of goods manufactured statement. Okay, and what we're doing here is we're taking our accounts that we have, our raw material accounts, our manufacturing costs, our work in process, and we're just showing how it flows through the system. Okay, so let's focus in on this raw materials right here. Now we have this calculation. Okay, this calculation's super easy, super easy. Okay, and I always ask all my accounting classes, how many of you guys balance your checkbooks? And nobody raises their hand because they says, why do we need to balance it? We got online banking, and I got the banking app, and it tells me exactly how much money I have at any given point in time. Well, it's not exactly true, because if you write checks, that amount won't show up. But anyways, I digress. The point of the checking account example is think how you balance your checkbook, right? At the end of each statement, right, you have a balance, okay? And then you add money into that balance, right, through deposits and whatnot. You have, once you add up your deposits and that beginning balance, that's the amount of money that you have available throughout the month, right? But then you subtract the ending balance, and that tells you how much you used, okay? So think about it this way. You take your beginning balance, you add your additions to the account. That gives you what's available to use. You subtract out the ending balance at the end of the month, and that tells you how much you used, okay? We're going to use that logic to calculate, how much we've used for raw materials, for finished goods, even for work in process. Okay, so let's walk through it. So raw materials. We start off with the beginning raw materials inventory, meaning at the beginning of the month, I'll say 1/1, okay? 1/1/2019. We have a certain amount of raw materials on hand that we can begin the period with to start producing products, right? Throughout that month, we're going to purchase raw materials, obviously, right? So as we purchase these raw materials, we add that to the beginning balance. So these raw materials purchased, this happened throughout the entire month of January, okay? When we add that to the beginning raw materials inventory, we have raw materials that are available to use in production, okay? Then we get to the end of the month. We don't know how much we used, but we look at our raw materials inventory and we say, oh, we have $200 left in inventory. Well, that means that the total amount that we had available to use minus the $200 of ending inventory tells us how much we used in production. That's how we get our raw materials. That flows to the cost of goods manufactured. Okay? In the cost of goods manufactured account, we already have the direct materials that were used, but we know, and hopefully we remember, that direct labor and manufacturing overhead that we apply goes into is part of our manufacturing costs. Okay? So we started off with raw materials and we're trying to calculate our manufacturing costs. We just saw how to get our raw materials. We're going to add direct labor. We're going to add the manufacturing overhead that was applied. That equals the total manufacturing cost that we manufactured throughout the period. Okay? Now the third step says we got to look at WIP. Okay? Now I'm going to say this again. We take the beginning balance, we add any additions to work in process. That gives us the total work in process for the period. Okay? We would then subtract the ending WIP balance, and that tells us how much cost of goods manufactured left WIP and went into finished goods. Okay? But let's see what we do here. Within our manufacturing costs, we have our total cost or total manufacturing costs. That flows to the WIP account that we see here. So within the WIP account or the work in process account, we have our beginning work in process inventory. Well, that means on 1/1, the beginning of January, we already have some partially completed units that have some materials, some labor, some manufacturing overhead applied to it, but we need to add more to it. Okay? So we're taking that beginning balance, we're adding the cost, the total manufacturing cost that we calculated for this period into WIP, and we get when we add the two, we get the total work in process. Okay? Now, to figure out the cost of goods manufactured, right? We need to subtract out the ending WIP, and that gives us our cost of goods manufactured. Okay, we're going to go through an example of this in the study guide. All right, we're going to go through the whole process. So once we get to WIP, right, we have our cost of goods manufactured, right? What do we do with them? Well, once we have cost of goods manufactured, those partially completed units that are sitting in WIP are now complete, right? They're not partially completed, they're 100% complete. We need to get them out of WIP and into our finished goods account. Well, guess what? Within the finished goods account, we're going to have a beginning balance. Say 1-1, make it easy, right? What happened was in 12/31, 2018, right? We had some completed manufacturing costs, right? We had some jobs or some products that we completed. They left WIP and they went into cost of goods sold. We didn't sell them at the end of December. So because we didn't sell them, that means we cannot recognize the expense yet. So they have to sit in finished goods on our balance sheet, okay, or the finished goods inventory account on the balance sheet. So during this period, we start with our beginning balance. We add the costs of goods that are manufactured. These are our completed products. We add to that the beginning inventory. We end up with the costs of goods that are available to be sold. How much did we sell? I don't know, but I know what my ending finished good inventory balance is. I subtract that from what's available. That is how I get my costs of goods sold. Okay? So let's do a quick check here, and this will really walk us through what the calculation. So we have raw materials inventory, right? The beginning was $32,000. Okay, that's our beginning balance. They tell us that during the month, $276,000 of raw materials was purchased. So that means we have to add our purchases. I'm just going to put for purchases, right? That is $276,000. When I add these two, I have $308, and this is the raw materials that's available to use. Okay, then they tell us that, oh, by the way, we counted raw materials at the end of the month and we have $28,000 left. So this will be the ending balance. So what is the cost then of raw materials used? Well, we just subtract the two. If my math's right, looks like we used 180,000. Actually, no, sorry, 280,000 in raw materials used in production. So our answer, hopefully, is C. Let's see if we're right. Yep, sure is. Okay. So, do you need to commit this to memory? Well, you could. Or you could visualize, okay, I start with my beginning balance. I add any purchases that were made. The beginning balance and any purchases that were made when added together equal what's available to use in production. I don't know how much I used, but I know how much raw materials I have left at the end of the period. I can subtract out that ending balance. That will tell me how much I used. Okay? So here it says direct materials used in production totaled 280,000. Direct labor was 375,000, and 180,000 of manufacturing overhead was added to production during the period. What were the total manufacturing costs for the month? So let's think about this one, right? To figure out my manufacturing costs, I know what make up manufacturing, right? My DM, my DL, my MOH, the manufacturing overhead. The problem tells me that, hey, I used $280,000 of direct material. I used $375 of direct labor, and I used 180 in overhead. So yeah, I can tell very easily how much my manufacturing overhead costs are. Oh, sorry. So they're 835, right? And we just add it up to figure out our total manufacturing costs. I just add up my manufacturing costs: direct material, direct labor, manufacturing overhead. So 835. Okay. So let's look at the beginning, or let's look at WIP, our WIP account. Or no, I'm sorry, cost of goods manufactured. What was the cost of goods manufactured, okay, during the month? So we need to look at our WIP account. Well, they tell us that the beginning WIP was 125,000. That means when I started the month, I had $125,000 worth of products that were partially completed. They tell me that, oh, by the way, the manufacturing cost for the month that we added to WIP was $835,000. So if I add these up, if my math's right, should be 960,000. But then they say, oh, by the way, you have 200,000 that was used, or I'm sorry, you have $200,000 of ending WIP, right? At the end of the month, we went and we counted all the partially completed products that we still have to add manufacturing costs to, but we have $200,000 left. How much did we use? Well, I'm going to subtract out that ending WIP balance, and I'm going to end up with 760, or 760,000. So that's my cost of goods manufactured. Again, do I need to memorize this? Well, yeah, it would help. Or if you understand how it works, you don't need to memorize anything, right? Take our beginning work in process inventory account. We add all the manufacturing costs that we incurred during the period. That gives us our total WIP for the period. We subtract out our ending WIP. We now know the cost of goods manufactured. So then they want us to figure out ending or finished goods, right? Finished goods. Well, you might say, well, wait a minute. It's asking for the cost of goods sold for the month. Why are we starting in finished goods? It's a great question. Because we need to know how much cost left finished goods and went to the income statement as cost of goods sold. Okay, so we can do that pretty easily. They tell us that the beginning finished goods inventory was 130. That's our beginning. We added to the finished goods account all of our manufacturing costs that left WIP, right? All the completed products They moved from the WIP account and they go into finished goods. That's 760. If we add these together, that gives us 890,000. My math's, yeah, right. Okay. This is what's available. Right? These are the manufacturing costs that were added. We then subtract out the ending finished goods amount, which is 150,000. This is ending. What do we have left? Well, 740,000. Guess what? This right here, my friends, is our cost of goods sold, or COGS. And there's the answer right there. Okay. How do we handle underapplied or overapplied? Well, we pretty much already saw how we do that, right? Remember, when do we have overapplied? Well, that's when the amount that we apply to jobs during the period, remember, we're always using the predetermined overhead rate to apply overhead. That amount that we apply is actually less than the actual manufacturing overhead that we incurred during the period. Okay? Overapplied, it's the total opposite. We applied overhead to the jobs, again using the predetermined overhead rate, but we applied more than we actually incurred in manufacturing overhead. Okay? We already saw this in our homework problem, or not our homework problem, I'm sorry, our study guide. We're showing how, okay, here's the applied amount. We applied 680, but we actually incurred 650. We over applied by 30,000. To fix this, that means we need to debit or hit the left side of the T account for 30,000. So we can get these two to be zero, right? The account is now zero. We had 30,000. We subtracted 30,000. We now have zero. We fix it to cost of goods sold. So because we over applied here, our unadjusted cost of goods sold is too high. We need to bring it down. How do we do that? With a credit or a right side entry to the cost of goods sold T account. That's how we're going to apply it. Okay. When you read through the chapter, it talks about disposing of any over or under applied using the three inventory accounts: work in process, finished goods, cost of goods sold. Using those three inventory accounts and the cost of goods sold to adjust. It's right here. Don't worry about that. I'm not going to have you do it. I think it just adds the complication. If you hit the cost of goods sold, that's fine. Okay, so that's it for chapter 3, but we're not done yet, because we have to finish our study guide. So I'm gonna stop the video now because I think it went fairly long. You can review it if you like, but what we're going to do in our next video is we're going to come back and we're going to hit up the study guide, and we're going to show how we create excuse me, that statement of manufacturing overhead. Okay, so tune back in for that one.